All right. Good evening, everybody. It is July 15th, and we're in our summer speaker series with the Lymph Balance Centre. And we love having our summer speaker series. It's ways to recognize and bring about professionals in the city of Calgary, in the province of Alberta, and even across Canada. We have a couple even from international, which is great this year. So on Tuesdays, Thursdays, and Friday evenings throughout the summer, we do have our summer speaker series, and all of the lineup is located on our Lymph Balance Centre Facebook group, as well as on our website. So feel free to check those out and check out the upcoming talks. But tonight we're very excited because we have Tom Stachiw from Matco Financial, who's going to share some really cool information about how to generate wealth after the COVID-19 pandemic. And I'm very excited that Tom not only made it back from the States, but is able to do this presentation for us this evening. So I'm going to pass this over to Tom, and we're gonna listen in and see how everything goes. Thanks so much, Tom, for coming and doing a presentation tonight. I really appreciate it.
Perfect. Yeah, thank you so much for having me there, Robin, and thank you everybody for joining as well. I know it's a busy Thursday night and Stampede week, so appreciate that all you guys took your time out of your schedule to come join us for this chat. So am I good to just rock and roll there?
You are totally rock and rolling it, man. So it's up to you if you want people to just leave messages in the chat, or if you want people to, if they have questions, to just voice it out loud, or what's your preference, sir?
Absolutely. If you want to voice it out loud, either one, really. If you'll be able to see the chat, I don't think I am able to there, Robin.
That's okay. I'll keep a track on it.
Yep. Yeah, it's absolutely can be interactive. I've got no problem being on my toes and people keeping me on my toes. So yeah, feel free to pipe up and ask questions whenever needed.
Awesome. Take it away, sir.
Excellent. Excellent. So my name is Tom Stachiw, as Robin mentioned, and I work with Matco Financial. We're a Calgary-based investment wealth management firm, and we were established in 2006. And today I'm going to be presenting, obviously, with the title on how to generate wealth after the COVID-19 pandemic. A little bit of a light in the end of the tunnel. Obviously, we're still living through COVID times, but be able to look forward over the next couple of years and plant some seeds in terms of financial planning, investments, and kind of the bigger picture of things on how to make money over the coming years here. So a little bit about myself first. So I've almost got a decade in the wealth management industry. I've been at 3 different shops throughout that time frame. I've always kind of been in the independent realm. So started at Richardson GMP, Canada's largest independent wealth management firm. Moved to another smaller Calgary-based investment firm, similar to Matco, called McLean & Partners, and then moved over to Matco in November of 2019, so just before COVID hit. It's been an excellent situation for me. Great team, and an excellent, I guess, almost year and a half, almost 2 years coming up here. So I am a portfolio manager at Matco Financial, which is one of the highest licensing and education spots in the financial services industries. The difference between us and a lot of other kind of investment advisors and financial advisors in the space is that we can trade on behalf of our clients. So we talk to our clients, understand their financial goals. I'll be going over that kind of throughout the presentation today as well. Get to know our clients a little bit better. We're restricted to how many client relationships we can take on. So we know what's going on in their lives and how to make money for them and structure them in the best possible way. The way that I'm able to be a portfolio manager is through my designation, which is a chartered investment manager. Held that for several years now. After graduating in Wisconsin, down in the States, I came back, and I've always had a goal of being a portfolio manager and being in the stock market and helping people out. So the fastest direction there was to get some exams written and get it off the table and sitting in that seat. So one of my shining lights in my career so far was I was named top 40 under 40 nominee in the IIAC Investment Association of Canada in 2018. And throughout my experience in the industry, I've worked on mostly high net worth books up until Matco. So it's one of our unique competitive advantages, but started in a book of 250 million, moved to a book where I was personally managing 130 million. And then now at Matco, we're just pushing about the 600 million assets under management mark, I believe. To move on, talking about the agenda today. So first of all, I just wanted to give an overview of Matco Financial for the individuals that are tuning in that don't really know who we are. We are a smaller firm in Calgary and obviously don't have the big budgets of the big banks to put up posters and commercials and all that kind of stuff. So love doing things like this. And once again, thank you, Robin, for being able to raise awareness for our smaller firms and how we can help people out. From there, I guess the bulk of the presentation will be more on that how to generate wealth throughout and after the COVID-19 pandemic. So we're going to talk a little bit, touch on budgeting and financial planning, something that we really focus on at Matco, making sure that we understand what our clients want, their financial goals, if they have the budget to get there, if the portfolio is set up for them to get there, and then make tweaks and suggestions on providing advice to help them along that line. Secondly, we're going to talk about debt consolidation and benefiting from lower interest rates. So it's a conversation that's been coming up a lot with my clients and prospects in terms of people either being unemployed or saving money, kind of the both sides of the spectrum throughout COVID, racking up credit card debt, lowering their interest payments, kind of the full range of conversations there. But where interest rates are today, there definitely is a lot of opportunity to save yourself money by debt consolidation. So I'm going to give an example on how that works. And then finally, to wrap the presentation up, I'm going to talk about how to protect your wealth against the ever-changing global environment. So things to watch out for, how to build a pretty solid bulletproof portfolio. Obviously, there's going to be bumps in the roads. COVID-19 was the quickest bear or recession market that we've had in history. It's also the quickest recovery we've had in history. So we're now back into a bull market. So how to take advantage of that, how to ride the roller coaster of emotion through that, and make sure that you profit on the other side and stay invested, most importantly, through all of the chaos that happens in our world. So at Matco, three of our core values are basically having smart funds, clear advice, and low fees. So as I talked about before, clear advice, the middle one there, is kind of where my seat falls in terms of being a portfolio manager, having a restriction of the type of client relationships we can take on and number of client relationships we can take on, understanding what they need, being able to provide clear advice to them and get them to where they want to be. On the left side there, we've got smart funds. So in-house, we've got an investment management team, which their job is to take the global universe of stocks, bonds, and focus it into companies and investments that we think our clients would benefit from. So one of our pillars is obviously protecting client capital with our smart funds and having our team that is dedicated to do that. We believe that we're able to provide that competitive advantage to help them get to where they want to be. And on the other side of that is low fees. So being Calgary based and keeping everything in-house, having our investment management team in-house, we're able to keep our fees low and pass that cost savings on to our clients. So one of the more unique things in our side of the industry, where you see commercials nowadays and all that kind of stuff, shining lights on fees. A lot of clients got a slide in a couple slides here where a lot of people don't know what they're paying in fees. And that's basically just eating into their returns over time. We do deal with a wide range of clientele base. So we're able to deal with the traditional bread and butter business of Matco. It was originally founded as a family office, so catered towards the high net worth in 2006. And then throughout time, we've developed the program to deal with asset gatherers, asset growers, people entering retirement, retirees, and the full range of individuals there. Quite a competitive model, in my opinion, being kind of all at a couple of different spots and all over the street. But being able to provide advice and give great, solid advice to individuals and family throughout their entire life. The way that we split that up in-house at Matco is kind of through the asset management arm and wealth counseling arm. So these are more ballparks, but our account minimum on the asset management side of things is $25,000. So very competitive in terms of looking at bank branches or people walking our smart folios or something that you sign up online. Being able to have somebody like myself guide you through that growing stage, young professionals, young families, people that are growing and saving their assets towards retirement. We're able to help them out in that asset management and asset gathering and growing part of their lifestyle. And then transitioning to either retirees or more successful young professionals will be that wealth counseling side. So focusing more on risk management. On both sides, obviously, we have clear financial advice, being able to provide tax strategies, estate planning, retirement planning, more of that whole wealth management structure. We still do provide that structure to the asset management side. Just it's not traditionally not as complicated when you're building and growing your assets. And then obviously the goal of the asset gatherers on the left-hand side there is to traditionally move into that wealth counseling structure to live in their retirement years and depending on their financial goals, obviously, be on that side. And as I mentioned, one of the things about our structure is the low fees. So very interesting in terms of not many investors know that the average fee on the street is about 2 to 3.5% annually. Almost half of the people surveyed in the survey that we have in our presentation here didn't know what their fund fees were. So that's a little bit alarming. There has been a lot of changes in the industry over probably about the past 5-10 years, where regulators are trying to bring this more to the forefront of what they are paying in fees, what the client is paying in fees. And then it's estimated that a 1% decrease in fees over 30 years could result in a 30% increase in retirement savings. So in this circumstance, it's kind of as I talked to at the very beginning, that decrease in fee and how Matco keeps everything in-house and passes along the cost savings to the client, that just returns within their portfolio over time. So rather than paying a third party for managing it or an extra portion to the advisor like myself or portfolio manager, that 1% decrease in savings just continues to grow within the client's portfolio. Then a perfect example is for our F-class, kind of that asset gathering side of the portfolio in terms of $25,000 to $1 million. Our balanced fund, which is a medium risk portfolio, is sitting at 1.35. So a significant discount to that average between 2 to 3.5% annually. Now enough about Matco. I think most people wanted to learn about how we're going to get out of this pandemic and generate some wealth. So as I mentioned, one of the things that we focus a lot on is financial planning and budgeting. So two big pillars of generating and keeping wealth throughout your lifetime. So budgeting on the one side, I kind of broke it down very simply. Can get a lot of, I've worked with clients that will have a simple spreadsheet that will have their income, expenses, and savings all the way down to, hundreds of lines of individual bills and picking away at individual things like that. So one of the things that we encourage people to know is, what's coming in and what's going out on a monthly basis. It's difficult for us to project things and understand what's going on. And if you don't, it's quite easy. It's kind of like a food log or anything like that. You can go through your credit card statement and figure out what you're spending money on and how much is coming in, obviously from paychecks or anything like that. And keep some sort of spreadsheet. We usually suggest for a month or two and have obviously any miscellaneous expenses excluded and all that. But getting a little bit of a snapshot of what's going in and out can really provide a lot of color on what's going on. So it can identify problem areas, obviously. So, I know through COVID-19, we had our first little guy, and we were spending a lot eating out from our budgeting and understanding from our spreadsheets. With Skip the Dishes was our best friend, and Uber Eats. So understanding that we were spending a lot of money there. So being able to see where the expenses are coming from and where your income is coming from can identify opportunities as well as major holes in your overall budget. From there, having a solid budget really helps us out in terms of being a portfolio manager in your financial planning. So with your financial planning, we use your monthly expenses, compounded into yearly expenses, identify your financial goals, and try to figure out the best way to save and invest. So a lot of this does fall on our plate in terms of, if we get provided solid information in terms of budgeting and expenses. But saving and investing is a little bit more complicated than a lot of people think in terms of tax efficiency, how the portfolio is structured, all those little nuances that we try to keep as much money in our clients' pockets rather than sending it to the government out east, right? So being able to structure the portfolio in a manner where we're able to benefit from it and keep those tax dollars in our pocket. We do focus, one of the main things and one of the main financial goals we work towards, obviously, is retirement planning. So one of the benefits from financial planning is kind of providing that peace of mind for our clients and prospects, that we're able to either identify where there's holes in their financial plan, and they're looking to retire in 10, 15 years. They might not be saving enough. They might be invested in improperly. They might not be invested tax efficiently. We can provide a couple of tweaks there. The opposite can happen too. I've sat down with several clients where, they're 40 years old, they're great savers, they've developed excellent habits, and their portfolio is at a higher risk than what they would probably really need to get them to their retirement goal. So it does go in both directions. Then finally, another thing that comes out of the financial planning exercise is, not a lot of people like to talk about it, but obviously estate planning. So very important when you are talking about significant wealth. And of course, if you have family, spouse, anything like that, to get your estate planning in check. So that will be talking about your wills, all the documents there, understanding gaps and holes, as well as talking about estate goals. So with financial plans, we can project how much money you would have at certain ages of death, and whether you want to leave money for charities or children, what's the most tax efficient way of passing that along. It's great to plan, rather than a lot of the conversations that we have is more around planning, and rather than things happening and trying to figure things out afterwards, right? Now on to the next one. So it's pretty much to hammer home the idea of having a financial plan. So the way that I always explain it to people is, you wouldn't drive to a new place if you've never been to Banff before. Probably put in your GPS or use a map. Nowadays, my father-in-law still uses maps, so I always throw that in. I think most people would use their iPhone, Apple Maps, or Google Maps nowadays. So the financial plan is basically that. It's a roadmap to your financial goals. So it's something that it's a living document that with our clients, we revisit usually on a yearly basis or every 2 years. Sit down with them, unless something major changes, obviously, but sit down with them and kind of just track along the line of where are we in terms of our plan? Are we ahead of schedule? Are things going well? What's the reason for that? Have we been saving more? Do we get a couple of bonuses? Did the portfolio return more than we expected it to? And then vice versa. Are we behind schedule? What's the reason? COVID-19 hit, and the portfolio sold off, and we're not worried about it. We're invested properly. It should bounce back. Or have we not been saving enough? Were we unemployed for a portion of that? Do we need to tweak the plan? It's that roadmap that kind of gives you that peace of mind, but also guides you to where you're going to be going. And then finally, having everything consolidated, as I mentioned, into one living document can identify issues in terms of investments. So if you do have accounts of different investment firms, there may be duplicates or doubling up on certain exposures within your portfolio. So let's say two of your managers are favoring Canada at the moment. You would have a very heavy, or not very heavy, but an overweight in Canada, which you may or may not be beneficial. Or the next one would be tax and estate opportunities. I kind of mentioned that in terms of restructuring things on a tax basis to make sure that we're keeping as much money within the portfolio and the client's pockets as we can. The estate opportunities will obviously be making sure that everything is left the way that we want it to be upon passing, and also savings goals. So being able to identify if we're saving enough or not enough for our financial future. Now I'm going to move on to the debt consolidation. As I mentioned, this has been a hot topic with a lot of prospects and clients in terms of low interest rates, as well as unemployment throughout COVID, racking up credit card debt. What's a better way to do that? So one of the things that I encourage everyone to do, obviously debt is a very individualized situation, but as a rule of thumb, traditionally lower monthly payments by consolidating debt is a good thing. So one of the things, as I have people come to me all the time, credit card debt is easily accessible. I always make the joke, you can, when there used to be games at the Saddle Dome, you could go to the Saddle Dome, they give you a free blanket and you'd have a credit card worth $10,000 of free money. The issue there obviously is you rack up the credit card debt at $10,000 and they charge you 20% interest on it until you pay it off, right? So there are different debt structures that you can take advantage of that can be a lot less expensive than that. As I mentioned, because of unemployment through COVID-19, debt levels have unfortunately increased in many households, but there is a smarter way to kind of approach it. So I'm going to go through a little bit of an example of how to do that. So this is a debt consolidation example. I take credit card debt. The dollar amount is $25,000 across the 3 different loans. The credit card is at 20% loan, and the yearly payment on that is $5,000. Pretty hefty, and much better way to do it. An unsecured loan from the bank right now would be hovering probably around 6%, which is still about a $1,500 payment on a yearly basis. And then finally, if you do have room from your mortgage and your market value price of your home, you may be eligible for a home equity line of credit, which is probably one of the best ways to structure debt, which right now would be probably falling right around 2.95%. So in this example, rather than having $25,000 on a credit card, paying $5,000 a year, if you had the eligibility to rotate that into the lowest structure of a home equity line of credit, paying only $737.50 per year, you actually save yourself about $4,200 in terms of interest payment. And a lot of this is, when you look at its structure like this, I've had clients and prospects go, "Oh, Tom, that makes a lot of sense. I don't know how I don't do that." But it's just easy accessibility to credit cards, I think. So, whether it's forgetting to pay it off on a monthly basis and you do get charged that dollar amount, having access to these different types of debt structures, whether it be a loan or a home equity line of credit, is a great option for people to tug on, rather than leave it on a credit card and pay an exuberant amount of interest there. So if you ever, I'm going to have my contact information at the end of this presentation, but if you do have questions about this, whether you go to your bank advisor or your financial advisor, somebody you're currently working with, or please feel free to contact myself. Happy to, debt structuring is very individualized, but more than happy to have the conversation at any point in time to help you save money. Next is how to protect yourself, how to protect your wealth in the ever-changing global environment. So this is a question that we get all the time. And at Matco, we are long-term investors. It doesn't really change all that much through business cycles. We change the portfolios quite often. And we've got that investment management team that continuously is evaluating the portfolio, looking for opportunities, selling individual positions, buying individual positions. But for the individual investor that comes up to me and, there's always going to be, hopefully we don't go through another pandemic, but there's always going to be something that sells off the market. And there's going to be another trigger that increases the market. The best thing that we still kind of pound the table on is investing in good companies with good management teams, understanding how they're going to make money through any type of environment, right? And being able to structure the portfolio every which way to place individual companies in there that will benefit from good times or bad, and have different positions on different themes as well. So one of the things I've got this slide here that kind of talking about avoiding the common investing mistakes. And these are basically the top things that I talk with clients and prospects about all of the time. So I'm going to go through each one on an individual basis, give maybe a couple of examples as well. I'm going to start at the top there with single stock concentration. So it's a great way to get rich fast. It's also a great way to lose a lot of money quickly. More of that binary outcome. We see this a lot, unfortunately, in Calgary. We see it a lot with oil and gas companies. So having a lot of risk in an individual oil and gas companies, or even a handful of oil and gas companies, but they're still affected in the same industry by the same thing, which is oil and gas, a trading commodity. So the opposite of this, obviously, would be diversification, which kind of rolls into number two. So lack of diversification and single stock concentration, they're very similar. Lack of diversification would be having all of your eggs in one basket. So picking that individual stock, picking that individual industry. So whether it be energy or tech or something like that, where if it works out well, obviously you'll hopefully make some money. But if you don't, but if it doesn't, then everything will probably be going down too. The way that you structure a diversified portfolio is to spread it out across different geographies. So Canada, US, international companies in different industries. So energy, technology, consumer staples, everything across the board there of companies that we think, or that you think, are going to continue to grow over time. Third one there is I think personally where advisors, portfolio managers, and our side of the business comes in with the most value is emotion. So emotional buying and selling is one of the things that can really hurt your portfolio, benefit and hurt your portfolio. Usually we see it as hurt your portfolio. So when a stock goes down, people might feel depressed, feel like they want to give up on investing. If you do have a solid portfolio, and that's what we saw through COVID-19 with the heavy sell-off that we experienced, and -5, 6, 7% days in the overall marketplace, it is a very emotional time. I was having conversations from 8 in the morning, sometimes till 8 at night, 9, 10 o'clock at night with clients and prospects. That it's kind of that doomsday scenario that everything's going to end. Their retirement portfolio is going to zero. The way that we're structured is, with that diversified portfolio, obviously we took a hit with the overall marketplace, but staying invested and explaining why we're invested in the companies that we are, and those companies proving that they were able to not only make money through COVID, but benefit on the other side as things get better as well. That bottom one I love all the time because I get clients calling me on a regular basis saying, yeah, I was just out skiing or at the Stampede with my friend, and he told me that their company is doing great. We relate buying stock tips to tossing a coin, 50-50. So, and usually I tell clients that you probably have better odds going to a roulette table. So putting money on red or black usually works better. Obviously, it can work, but it's not necessarily a solid investment strategy to build a portfolio off of. Chasing yield has become a significant one over the past couple of years with the baby boomers rolling into retirement and generating income off of the portfolio. There are some great companies that do pay good dividends. So yield would be the percentage of dividend that a company is paying to their stock price. So if they've got a higher dividend, traditionally what that comes with is higher risk in the underlying stock. You have to do your homework to understand why that some companies do have a high dividend because they're a good cash flowing business. But you do have to do your homework to kind of dig into that side of the underlying name. And that rolls into the last one there. So lack of research. And I love chatting about this with clients, prospects, anybody that, it's our full-time job to be picking investments for portfolios, being able to help our clients and understand what the companies are doing within the portfolios. Obviously, there are tons of options for do-it-yourself investments, and a lot of people are very successful doing that. Some people bring investing in as a hobby. I've got tons of clients that will have their hobby portfolio, and then we've kind of got their don't mess around money. But at the end of the day, you really have to think about how much time you can put into research and understanding the underlying names within your portfolio. Obviously, things change on a daily basis, both in the markets and in individual companies. So traditionally, like even myself, I'd still, as a portfolio manager, I deal with clients and relationships, but I don't manage my own personal portfolio. I give it to the Matco team to be able to pick the stocks for me. Next, one of the things that we always talk about is having a disciplined approach. So even if people are doing it themselves, being able to eliminate a good chunk of that emotion by having a disciplined approach with their portfolio. So at Matco, we call it our M factor, which is a process-driven approach. And we've also got obviously that team that picks both equities and fixed income, so stocks and bonds within our portfolios. But having that discipline of one, when to buy, and two, which is traditionally a little bit more difficult, when to sell an investment is something that is incredibly important in the ever-changing environment that we do live in. The next one here is understanding where you want to be and how to get there. So this kind of loops back to the beginning of my presentation, and we're getting close to the end here. But understanding where you want to be is one of the things that we can identify with a financial plan. So being able to understand how much money you need for your financial goals. If you're structured, the best way to get there. On this slide, what I've got is the expected return of the portfolio on the left axis there, and on the bottom is the expected risk. So we've got the different portfolios that we have in-house at Matco, our structured portfolios. That'll go from the bottom left corner will be our conservative portfolio at majority fixed income, 90% fixed income and 10% equity, all the way up to growth on the far right there with 90% in stock market or equity market and 10% in fixed income. So the reason that I put that on there is to hammer home that idea of generating a financial plan, understanding your financial goals. If your portfolio is matched up to where your goals want to be, a lot of do-it-yourself investors and things like that that don't understand the bond market or never really dabble in it, where it's traditionally the safer portion of your portfolio. So I've done reviews with prospects and clients of their other accounts where they'll be 100% in the stock market and taking a lot of risk when it's not really needed to be there. So understanding where you want to be and how to get there is a major thing that we talk about on a regular basis. And finally, to wrap things up, I'd love to work with you on your financial goals. If anybody on the call here or anybody that watches this would like to contact me for a free, no obligation financial plan. The reason that I got into the industry was to help people out, and it was one of the reasons that I moved to Matco. Obviously, with being able to build and grow with asset gatherers, work with people that can use my advice and build and grow throughout their career. It's one of the things that I love to do. So young families, young professionals, all the way up to retirees and older families and going into retirement. That's right in my wheelhouse there. So this is my contact information. That's my cell phone on there. I give it to all my clients and prospects. Feel free to call me at any point in time, and hopefully we can connect. So I think I'll hop or loop Robin back in. Is there any questions there, Robin? Or
I didn't notice any in the chat. Some really good comments about agreeing exactly with what you were saying, which is on par. But yeah, I didn't see any. Does anybody have any questions or anything that they'd like to ask Tom while they're here? And we are still recording, which is totally fine, but I think everybody's on the same page, and it was an awesome presentation. I loved the charts and everything. It makes so much sense, especially for myself, who, I'm protest as being an absolutely horrific financial individual in the sense of understanding the concepts, which is why I surround myself with some of the smartest people. And yeah, really great presentation though, Tom. I loved it.
Perfect. Perfect. I appreciate that, Robin. Thank you.
Yeah,
Well, then if anybody on the call does have questions or thinks of something afterwards, more than happy to answer a call or answer an email when they have time.
absolutely. Thanks so much again, Tom.
Excellent. Thank you
All
for
right.
having me.
My pleasure. Have a great
Okay.
evening, everyone.